I'm now joined by Lance Humphrey, Head of Portfolio Management with the VictoryShares and Solutions team at Victory Capital. So Victory Capital is a nearly $300 billion global asset management firm. And as part of that, they offer the VictoryShares lineup of ETFs. So this is now 26 ETFs, including 3 ETFs launched last week. And I'll tell you, I think some people might be surprised to learn that ETF lineup is now nearly $15 billion in assets, more than $6 billion of which has come in over the past year or so. So VictoryShares has quietly been climbing up the ETF leaderboard. And a big driver behind that has been the VictoryShares Free Cash Flow ETF, ticker VFLO, VFLO. That alone has taken in nearly $4 billion over the trailing 1 year. But I now have Lance on the line with me from San Antonio. Lance, it is so great to reconnect, and welcome back to ETF Prime.
Nate, great to be here with you, and again, great to talk to you again.
So it is interesting. You know, Victory Capital oversees nearly $300 billion in assets, but I'm not sure you necessarily get the commensurate attention. My sense is not everyone is as familiar with Victory Capital as perhaps they should be. I don't know if you feel that way, but I thought before we get to the ETFs, tell us a little bit more about the firm itself.
Yeah, well, again, I think you hit on a couple of the key points. You know, we are a really one of the fastest growing asset management companies in the business. As you mentioned, $290 billion in total client assets. And I think we have a really unique business model at Victory Capital where we have a model that combines boutique investment capabilities along with an integrated investment platform, an integrated operating platform. So there's different brands that investors may be familiar with at Victory Capital. It could be our VictoryShares lineup. It could be West End Advisors. It could be Sycamore Investments. And so having those different investment franchises, we brand those a little bit differently. But from an offering perspective, we have anything ranging from mutual funds, ETFs, managed accounts, alternative investments, and more. You mentioned we're proudly headquartered here in San Antonio, Texas. And I think that might be, part of the reason you mentioned we're not there in the middle of all the New York-based firms. But I think that is what sets us apart from some of the other businesses out there.
And so the ETF lineup, again, VictoryShares, we'll get into some specific products in a moment, but just at a high level, I'm curious, how are you attempting to position in the marketplace? And, I know you personally have been involved with ETFs for a while now, so you certainly know how competitive this environment is. It's a tough place to stand out, but obviously with the inflows I mentioned, VictoryShares is competing very well here. So what's been the overall approach?
I think right now you could categorize our ETF lineup really into one of two categories. The first one's a little more straightforward, which would be active ETFs. So I'm sure we'll talk about a few of those, but that would be your traditionally actively run funds, whether that be in fixed income or sector selection. The other would be in what we would call our rules-based systematic index funds. And I think that's one where, as we talk about VFLO, that would fall into that category where I think we fall into a theme of we're not necessarily the first firm to bring an idea to market, but we spend a lot of time thinking about how can we improve upon ideas that already exist. And we have a lot of examples that at a high level, a couple would be, if you think about the theme of equal weighting, right? There's a lot of advisors who are looking to deconcentrate the risk associated with some of the concentration in the market cap weighted indexes. So while equal weight products have existed for quite some time, we have a suite of products that we call our risk-weighted suite, which is I'd call it a derivative of equal weighting, where we try to make a small improvement by controlling for volatility that you would typically get with equal weighting. And again, there's several examples of that. And as we'll talk about VFLO, I think that's going to be an example where we certainly didn't introduce the idea of value investing, or even more specifically, the idea of focusing on free cash flow. But I do think that we built in a few enhancements to the product that are resonating with advisors. And that's a theme that you'll see across the 26 ETFs, really trying to improve investor outcomes on investment ideas that exist in the marketplace today, again, alongside traditional active.
Well, let's actually just talk more about VFLO here because I feel like it's the poster child for the success that you're having with the ETF lineup overall. Again, VFLO, that has seen nearly $4 billion in inflows just over the trailing 1 year. Tell us more about this ETF and why you do think it's resonating with investors right now.
I think it really comes back to the design and the idea behind it. I can tell you, over my career, I've been trained and I tend to lean a little bit more into value investing. I think that valuation is important. But if you look at the headline indexes, let's say the Russell 1000 Value or the Russell 1000 Growth, it has not been a fun time to be a value investor over those 15 years. So you sit back and ask the question, well, what is it about value investing that has led to lackluster results, particularly relative to U.S. large cap growth? If you think about the research that was done on value investing, really dating back to the early 90s into the early 2000s, what were the types of companies that led into that research, right? It was data from the 1970s, 80s, or 90s. These were companies that were manufacturing automobiles or airplanes or railroads. And you think about the measures that were utilized from a traditional value approach, things like price to book. Well, the book value of assets was a decent representation of what a company might be worth in the 70s, 80s, 90s, and 2000s. But if you think about today's economy, the composition of companies, the way companies earn their revenue, earn their profits, is very different. You think about social media companies, various communication or IT companies where perhaps their book value might be quite low because they have intangible assets, things like their patents, their processes, their trademarks, their people. So what I think has happened over the last 10 to 15 years is because of that, we really needed to evolve how we define value. And what we've done specifically with VFLO is rather than focus on more traditional measures of valuation like price to book or price to earnings, instead we focus on free cash flow. Again, free cash flow we find to be a very powerful concept historically. It's one that makes intuitive sense. If you talk to any business owner about how they think about their business, they'll tell you, I want to have more cash in my bank account this month than I did last month. That means their cash flow is improving. And so when we look historically at the data, what we find is that free cash flow tends to be a more effective measure to define value. Again, in most of the research we've looked at, it's over the last 20 or 30 years, we find that if we compare free cash flow yield to those traditional metrics, we find that oftentimes it's able to improve investor outcomes, whether that be higher returns or lower risk. So in our product at VFLO, we are specifically focusing on free cash flow yield as the measure to define a company's valuation.
I was looking at the summary prospectus. Essentially you're starting with the largest 400 profitable companies. That's sort of the starting universe. You're then selecting the 75 highest free cash flow yielding companies from that universe. And then from there, you talked about the growth metrics. You're selecting the 50 stocks with the highest growth score. And then lastly, you're weighting those 50 stocks by free cash flow. And there's some nuance here. Holdings are capped at 4%. I think you have a cap on sector exposure as well. And so, high level, I think that paints a really good idea as to what you're doing here. One question I have, I always like to just take a big step back, and you've talked about how this may compare to some other value approaches. How would this compare if an investor is looking at VFLO compared to the S&P 500? What would be the key differences that they'll find if you had to summarize them?
I think I'll start with a similarity, which would be, and you mentioned this a moment ago, we're in the same starting universe, essentially, as the S&P. So if you think of the S&P 500, that's going to be approximately the largest 500 companies in the United States. So we'll call that U.S. large cap. You mentioned on our product, we start with the 400 largest profitable companies. You might say, well, why 400 instead of 500? Something we haven't mentioned up to this point is this product does not invest in financials or real estate, primarily due to the fact that free cash flow tends to be less effective for those types of companies. So generally speaking, if you look at the S&P 500 and remove financials and real estate, you have about 400 names on average. So I think of the universe for both the S&P 500 and VFLO to be U.S. large cap. That's really the primary similarity. From there, there are going to be differences. I think the first one is, again, the S&P 500, I think of as a way to gain passive exposure to U.S. large cap companies. VFLO is now going to take a more specific approach to identify a specific set of U.S. large cap companies. What that leads to is VFLO is going to be considered more a large cap value product as opposed to a large cap core. So that would be one primary difference. Number two, VFLO is going to take a more concentrated approach. So as you alluded to a moment ago, the index for VFLO has 50 stocks, and that's rebalanced quarterly, as opposed to the S&P 500, of course, which is going to have 500 stocks and rebalanced on an annual basis. So it really comes down to looking to achieve a different objective. I think of the S&P 500 as trying to achieve broad-based U.S. large cap exposure. VFLO is more designed to provide, again, a subset of that with a focus on valuation and quality.
Okay, so you mentioned the focus on valuation and quality. In looking at the lineup, you also offer a free cash flow growth ETF, which if you look at flows, that's seen really nice interest. And the ticker symbol on that is GFLW. So as I look at this, Lance, it looks like a similar strategy in terms of focusing on free cash flow. But my understanding is it's more looking at companies with positively trending free cash flow versus a absolute free cash flow. Is that correct? And so you pick up more of a growth bias here?
That's right, Nate. I think what our research found as we were building these products, as I mentioned before, free cash flow in general has tended to be a more effective definition of fundamentals for a company. Now, in the case of VFLO, we're essentially looking at what is the level of free cash flow relative to the price I have to pay to obtain it. The difference in GFLO would be simply I want the high level of free cash flow. So price isn't as much of a factor in GFLO. Now, again, what led to this product was, I mentioned before, the last 15 years have been outstanding for growth investors and for growth indexes. What we wanted to do is look into, well, what has led to that strong level of return? Because again, if I think about the research I've done over my whole career, I really have the idea that if you simply look at high growth versus low growth, so let's say we take the S&P 500 and we split it in half, the highest growers, the lowest growers. Historically, the slowest growers have actually outperformed a little bit, which again is counterintuitive. But then it's hard to reconcile that to say, well, how could that be the case when the last 15 years growth has done so outstanding? What we found is it's not necessarily the growth of the companies in these big market cap weighted indexes, it's their profitability. If you think about companies in the Mag 7, many of them have tremendous levels of free cash flow, and they're growing and compounding that free cash flow. So GFLO is a product that was built to target that more specifically. Like I said, in today's market, you can get some of those attributes in the market cap weighted indexes, but GFLO more specifically targets companies that, as you alluded to, have a positive trend on their free cash flow generation. And then from there, we're selecting the companies with the highest level of free cash flow relative to the capital required to run their business. So again, you could think of GFLO more as a growth, quality, momentum-oriented play on free cash flow. And then VFLO is going to be more of a value quality play on free cash flow. And so the last thing that I would mention is we really built these products, and these indexes are designed to complement one another. And so I think that's part of the reason that we've seen some early success in this product from individuals or advisors who may own VFLO and are looking to complement that exposure on the growth side of their portfolios. So I really think of the two as a pair to one another, both focusing on free cash flow, but again, one being free cash flow value, one being free cash flow profitability.
All right. One other ETF on the equity side that stood out to me is the VictoryShares U.S. Small Mid-Cap Value Momentum ETF, ticker USVM. Clearly a multi-factor approach. Just give us a quick snapshot on that one.
Yeah, the real quick point there would be, you mentioned up front, I've been an investor in ETFs for many years now in the asset allocation portfolios that I run. Going back to the 2014, 2015 timeframe, I was a user of factor-based products, whether they be focused on value or momentum or quality. And at the time, there was a lot of great products that focused on individual factors, but there wasn't a lot that focused on how to combine them in what I felt was a more effective way. There were several products that had 4 or 5 factors all at once, but specifically it was, what about a product that only focuses on value and momentum? Because one of the issues with investing in a factor separately, let's take value and momentum and think about today's market in particular. What we find are the companies that are exhibiting the best momentum today also tend to be very expensive. And conversely, if you think about the companies that are most attractively valued today, those are companies that tend to be trending downward. So the problem is when you put a value and a momentum product together separately, they oftentimes cancel each other out. So even though one is value, one's momentum, you combine them, you're left with neither. The idea with the value momentum suite of products, and USVM in particular, is we want to combine those two attributes simultaneously. So that index is looking for companies that have both attractive valuations and improving price momentum. So it's really about combining the factors from a bottom-up framework as opposed to putting them together separately. And so generally speaking, the investors, that product, that's specifically what they're looking for, is a way to maximize their exposure to value and momentum by not allowing it to get diluted when putting it together separately.
Lance, on all of the ETFs we've discussed so far, I would characterize these as quote-unquote smart beta ETFs, which, by the way, do you still like that term, or do you think there's a better descriptor? I've heard you say rules-based here. What do you think about that term?
It's one of those, funny. I think that had I come up with, or had I been charged with coming up with what we would call these products, 10 plus years ago, I don't think I would have come up with smart beta. I think there's certainly some reasons that might not be the best term. That being said, even if you look in some of the most widely used databases today to describe these products, you'll oftentimes see the word smart beta. So I'm not necessarily opposed to it. Certainly I don't mean to imply that these products are smart and others are dumb, but I do think it's a term that has kind of caught on. So you will hear me from time to time utilizing it. But as you alluded to, I tend to say systematic rules-based, which is probably not the most exciting marketing term. So there's probably a balance between, something that's somewhat catchy and something that's a little bit more descriptive. But, I could go either way.
Well, and here's where I was heading with this is that there has been a lot of talk over the past several years about the rise of actively managed ETFs. And if you look at the numbers, that they would back that up, right, in terms of inflows and new launches. And I'm just curious, given how VictoryShares is positioned with a number of products on the equity side here, how do you think investors should approach smart beta or systematic rules-based ETFs versus active ETFs? Because it just seems like active is getting all of the buzz right now.
Yeah, I think that's for several reasons. Number one, and again, we won't go into the details, but over the last few years, there's been some changes in regulation that have allowed for actively managed ETFs to be run more efficiently. So I think that's one reason that you're seeing a much higher kind of rate of launches within that type of product set. I think investors are just becoming more comfortable with ETFs. So again, as I talk with advisors on a daily and weekly basis, if I think back to a few years ago, it was not uncommon to see a portfolio with zero ETF exposure. I would say today that's very uncommon. We find that ETF usage has picked up significantly. That being said, for many reasons, ETFs oftentimes are going to be the most effective vehicle to deliver an investment strategy, whether that be passive, rules-based, or active, for, again, many reasons: the transparency, the potential tax efficiency, et cetera. So I think what we're finding is that as investment manufacturers or asset managers such as ourselves bring new products to market, generally speaking, that's going to be in an ETF. When I think about our product launches over the last several years, it's been exclusively focused on the ETF as the vehicle. Of course, we do SMAs and other products, but in terms of ETFs versus mutual funds, we're going to continue to launch ETFs predominantly because, again, there's many features from a vehicle perspective. So I think that's probably one of the main reasons that you've seen active pick up more in the last several years, again, is the combination of improved regulations that allow them to be run more effectively and also investor comfort in the ETF as a vehicle.
All right, before we move on, because I do want to ask you about a couple of bond ETFs as well. Any key considerations for investors on the equity side right now? Like as you talk to clients and you look at their portfolios, what do you think investors should most be paying attention to right now?
So I think both of these are probably, well covered in the market, but I do think that they are important. And the first one would be, we talk a lot about concentration. And again, anytime I read any article out in, whether it be sell-side research or otherwise, you see the concept of concentration talked about a lot. I think maybe my spin on it would be what I see a lot when looking at advisor portfolios has been more how these same 7 companies are finding their way into so many different products. So oftentimes we'll have an advisor that will share their allocation with us, and it might be a dividend value ETF, a large cap quality ETF, and a large cap growth. If I were just to say those 3 names, it would be very reasonable to say those should be very diversifying to one another. It sounds like 3 different investment themes, 3 different investment ideas. But what we're finding is if you look under the hood, oftentimes the same stocks are the top 5 holdings of seemingly different investment strategies. So I want to be clear that, it's not necessarily that I think that the Mag 7 or the largest companies in the universe are poor stocks that should not be invested in. I would just caution investors to look through the ETFs they hold and ensure that you're truly getting the diversification that you seek by ensuring that you're not holding really just the same thing in multiple different line items. So that's number one. And then number two, again, this is also, a topic that's been discussed ad nauseum over the last several years, but we are seeing some recent developments, which would be I'm starting to see advisor interest tick up a little bit in international investing. It's been a topic that's been a sore subject for many over the last few years, given the performance of international and emerging markets. But we're starting to see a little bit of a resurgence in performance in that space. And one thing that I find somewhat surprising is that if we go to the end of 21 until today, international stocks hedged in their local currency have actually outperformed the U.S. large cap market. That's been somewhat obfuscated by the fact that the U.S. dollar has strengthened. So many of the products that many investors hold in international markets are going to feel the impact of the strengthening dollar, in the way that would manifest itself is that would mean that those international securities are underperforming as a result. So number one, I would say it's been a decent period of time where we're actually seeing international companies doing quite a bit better than they had historically. This year, it's a little bit of both, where the dollar's weakening and in local currency, those companies have done well. So I do think it's something to consider in investor portfolios, is to, keep an eye on your international exposure. And, this could be a time to consider adding exposure there.
All right, just a few minutes left here. Let's quickly move over to the bond side. And I'll mention 2 ETFs here. So the VictoryShares Core Intermediate Bond ETF, ticker UITB, and the VictoryShares Short-Term Bond ETF, ticker USTB. Notably, both of these are actively managed, and you have a few other active bond ETFs as well. And I should note, those 2 ETFs I mentioned, those are the second and third most popular VictoryShares ETFs overall. And so I guess what I'm most curious about here, you can certainly touch on those ETFs if you want, Lance, but why active on fixed income after we were just talking about the rules-based approach on the equity side with some of the ETFs?
Sure. And I do, if I think about the portfolios that I manage, we tend to rely more heavily on an active approach as opposed to a passive approach in fixed income. I think there's 2 big things that I think about. Number one would be the weighting of traditional indexes on the fixed income side, and then number 2 would be the opportunity set. I'll start with the weighting. If you think about broad-based bond indexes, they're generally going to be weighted based off of the amount of debt outstanding a company has. If I were just to put this in everyday terms, Nate, if we were to think about, which of our friends or family we want to loan the most money to, we're probably not going to pick the one that has the most debt, right? It's almost backward in the thinking to put more money into the most indebted companies or the ones that issue the most debt. So I think, one, there's an issue with the weighting. Number 2 would be opportunity set. We were talking about equities a minute ago. If you think about things like the S&P 500, the Russell 1000, most publicly traded companies that meet the criteria in terms of being large enough to fall into those universes will be in that universe. So the opportunity set is pretty well defined in equities and pretty well accessible. That's not necessarily true in fixed income, where there are a lot of issues and issuers that may be attractive values in a portfolio that you would not find within a broad-based index. Even full asset classes, there's many types of securitized debt, whether it be CMBS, asset-backed securities, taxable municipals. These are bonds that oftentimes can look quite attractive, and active managers have the ability to add those to a portfolio, and oftentimes they're not found in the more passive indexes. And so I think, if we think about kind of the conventional wisdom, there's been studies that we've all seen that say, passive tends to work better in places like U.S. large cap. Oftentimes those same studies, if you keep digging through and get down to the deeper pages, you'll find that the statistics do change on fixed income, and that fixed income active has historically had a better opportunity to outperform those broad-based indexes. And I think it's because of those two factors that I mentioned.
Before I let you go, same question that I asked you on the equity side. What do you think investors should most be paying attention to with their fixed income exposure right now?
I think it's really that if you think about a fixed income portfolio, whether you have 2, 3, 4, 5 holdings within that bucket, they all typically will share similar risk characteristics. Some amount of risk to duration, meaning a change in interest rates. Now, of course, short term will be less subject to that risk than longer duration, and then credit risk. And so I think it's important to think about diversification within the fixed income part of your portfolio. That can include things like fixed income alternatives, or it could include parts of the fixed income market that are less correlated than many of your core or core plus type asset classes. And so I think it's important to diversify not only within fixed income, but I also think it's important to think about the full portfolio setting. One thing that we've seen really going back the last 3 to 4 years has been that we went through a long period where fixed income was a very strong diversifier against equities, meaning, mathematically speaking, they were more negatively correlated to one another. Over the last few years, that shifted somewhat to where we're seeing stocks and bonds have begun to have more correlation to one another. So I think it's also important to consider your full portfolio and look for ways to diversify beyond traditional stocks and bonds. And again, that could be via liquid alternatives or other uncorrelated asset classes.
Well, Lance, really enjoy the conversation this week. Just excellent detail on the VictoryShares ETF lineup and your perspective on the markets. Congratulations on all the success here. Certainly wish you the best moving forward. Thank you for joining me this week.
Yep. Nate, great to be here. Appreciate it. Hope you have a good one.
That was Lance Humphrey, head of portfolio management with the VictoryShares and Solutions team at Victory Capital.